Before we start today's show, I just wanted to mention our sponsor, Moneyfarm. Now, Moneyfarm is a leading digital wealth manager with over 60,000 active investors with over £2 billion invested on its platform. Now, it offers three main investment products, including a stocks and shares ISA, a general investment account, and a personal pension. By answering a few simple questions about your investment goals and attitude to risk, you'll be matched to one of the 7 globally diversified portfolios. Moneyfarm's expert team provides hands-on investment management by regularly adjusting and rebalancing your portfolio on your behalf. You'll even get a dedicated investment consultant should you want to widen your investment plan, which is something that sets Moneyfarm apart from most of its competitors. The minimum investment amount is £500 and fees range between 0.35% per annum and 0.75%, depending on the amount you have invested. Money to the Masses listeners can take advantage of a special offer where Moneyfarm will run your money fee-free for a year. Head over to moneytothemasses.com and search Moneyfarm for more information. Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, in last week's show, I told you to keep an eye on the US dollar index, which you can do on your phone. If you go to the stock app and you look at dx-y.nyb, then you can follow the strength of the US dollar index. And I said that if we do start to see the dollar fall in value, then we may re-enter a world where equities and bond yields rally at the same time again. Now, if you go back and look at the chart over the last year, you can see the ebbs and flows, which also coincide with the market's narratives at the time of whether we were entering a period of reflation or stagflation. And this ultimately dictated the assets that won and lost over the subsequent months. Now, the early signs of dollar weakness that we began to see just before last week's show continued into this week, with the US dollar index falling by roughly 1%. Now, while there has been some respite today, just before I've made this show, it's still a trend to keep an eye on. Part of the reason for the dollar weakness is that traders are now betting that other global central banks, including our very own Bank of England, will raise interest rates before the US Federal Reserve does. Now, with the US dollar weaker over the last week, we have indeed seen equity markets rally at the same time as bond yield rallying. We saw the 10-year US Treasury yield hit a high of 1.67% earlier in this week. At the same time as that, the S&P 500 has rallied strongly and now sits just 0.4% below its all-time high. Now, if you dig below the surface of the S&P 500, you will see that over the last week, every sector has been in positive territory. And it's the defensive sectors and those that tend to perform better in a stagflationary environment that are lagging those that tend to outperform in an inflationary one. So evidence of that is if you look at financial stocks, they are up 4.3% in the last week. Consumer discretionaries are up 4.3%. In contrast, healthcare stocks are up 2.6%. Real estate stocks are up 2.1%. Both of these are seen as stagflationary trades, while defensive consumer staples are up just 0.3%. And utilities didn't fare much better either. And the risk on sentiment that we've seen is probably best demonstrated by the 5% rally in technology stocks. So it's a great example of all the things that I've been talking about in the last couple of weeks coming together and then actually bearing out in reality. Now, when it comes to inflation hedges, often the difference between the performance of gold and Bitcoin comes down to the prevailing risk sentiment in investment markets. I did a whole Money to the Masses Sunday podcast on this very fact, so go back and find that show if you're interested. Now, when inflation is rising and investors' animal spirits are alive and well, Bitcoin tends to outperform. And when rising inflation is met with investor caution, then gold tends to outperform. In the last week, we've seen Bitcoin rally more than 17%, and it's now near its all-time high, while gold fell 0.3% over the last week. And now, yes, a large part of the rally in Bitcoin's price in the last week has been a result of the first ever Bitcoin futures exchange traded fund, which is obviously known as an ETF, in the US making its debut on Tuesday on the New York Stock Exchange with the approval of the US Securities and Exchange Commission, which is known as the SEC. But taking everything in the round, right now, investors' optimism has returned and they are buying the recent equity market dip. It will be key to see if the S&P 500 can set a new all-time high in the coming days. And that's because a new all-time high can only be seen as a bullish sign for equity markets. Now, much of the source of optimism of recent days has been stemming from the unfolding earnings season. So, for example, an earnings report from the consumer goods bellwether Procter & Gamble. So there's lots of products that we all use at home. Its earnings report beat market expectations, which actually therefore boosted European equities as it showed that inflation shouldn't necessarily hurt corporate earnings as they were able to pass on some of that inflationary pressure. Now, if we continue to see such a trend in other earnings figures throughout this season, then it will likely encourage investors to start to increase their equity exposure, especially given that bonds are still hemorrhaging right now. In the coming week, we will also get earnings reports from a host of US tech giants, including Facebook, Apple, Alphabet and Microsoft. So the question is, will these reports see the tech-heavy Nasdaq 100 push to a new all-time high, which it currently only sits 1.5% shy of? The positive sentiment among investors has gone beyond the US and Europe. We've seen the Nikkei 225 over in Japan rally by almost 4% in the last week, thanks largely to a weaker yen. While Chinese tech stocks are also looking like they're trying to find a floor to this year's rout and have rebounded in recent days. I mean, if you look at Alibaba shares, for example, they're up about 9% in the last week, while Tencent shares are up about 6% in the last week. But it's not all good news out of China. So we've had some more poor economic data. We've also had news that the rescue of the embattled Chinese property company Evergrande seems to have stalled somewhat, and we could have far-reaching consequences in the coming days. The crisis has largely been put to the back burner and out of investors' minds, but it could be about to return to the forefront if Evergrande fails to pay an $83.5 million bond interest payment on Saturday night. And that would trigger an official default. So for now, at least, the market continues to be taking a half-full view of the economic and investing backdrop rather than a half-empty one. And next week could test investors' resolve or prove just how resilient the market really is right now, especially as we head into that seasonal tailwind that we normally get into the year end. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email. Damien@moneytothemasses.com is the email address. Twitter, moneytothemasses with the number 2. Of course, we're on Facebook, we're on TikTok, we're on Instagram, and don't forget to subscribe to our YouTube channel.